Welcome to HSBC Global Viewpoint, the podcast series that brings together business leaders and industry experts to explore the latest global insights, trends, and opportunities. Make sure you're subscribed to stay up to date with new episodes. Thanks for listening, and now on to today's show.
This podcast was recorded for publication on the 19th of June 2025 by HSBC Global Investment Research. All the disclosures and disclaimers associated with it must be viewed on the link attached to your media player. And don't forget to like and subscribe to the Macro Brief wherever you get your podcasts.
Hello, I'm Piers Butler in London, and this is the Macro Brief, where we look at the issues driving financial markets across the globe. Now, the intensifying conflict between Israel and Iran is dominating the headlines, and the events have introduced yet more uncertainty into the global economy. So today we're looking at the potential implications for markets. To do that, we have Kim Fustier, Head of European Oil and Gas Research, here in the studio. And joining us on the line is Murat Ulgen, Global Head of Emerging Markets Research. Kim and Murat, great to have you here.
Great to be here.
Thanks, Piers.
So we obviously can't offer views on the direction of the Middle East conflict between Israel and Iran, but we can firstly take stock of what's happened in markets and perhaps give some sense of the implications if there is no quick resolution. So, Kim, if I can turn to you first, where are we on the oil price? In fact, the last time you were on the podcast, I recall we were discussing you lowering your forecast based on the anticipation of OPEC Plus plans to increase production. Is that still the case? And to what extent can that increase offset perhaps the impacts of any production cutbacks in Iran?
Sure, thanks, Piers. So, oil prices have jumped by something like $10 a barrel, at least at the time of recording this. I think it's worth just recalling that the last two times there was a conflict between Israel and Iran last year in April and October, oil prices jumped by a similar amount, about $8. But the geopolitical risk premium did not stick because oil supplies were not affected. And so what we've seen is so far some regional energy infrastructure being hit. There was a refinery being hit, a fuel depot, even a gas field. But crucially, no oil fields and no oil export terminals. So if the conflict does not escalate from here and oil supplies are not affected, then we would expect the current geopolitical risk premium to eventually unwind. But then conversely, if supplies are disrupted, whether that's production or flows, then we should expect some further oil price upside from current levels. Iran is a very large oil producer.
Give us a sense of scale on that.
Yeah, it's about 4.5%
of world production.
Of the world oil production. Exports about 2%, so 2 million barrels a day, mostly to China. And if that were to be disrupted, on paper, OPEC Plus should be able to absorb that through its spare capacity, which is currently about 6 million barrels a day. It is slowly going down as they're increasing production, but right now it's very comfortable levels, about 6 million barrels a day. But in that scenario, because that spare capacity cushion would diminish, you would still expect prices to go up.
How long, in practical terms, they can't just switch on this extra capacity, can it? It takes a while.
In theory, it should not take that long. Spare capacity is defined as capacity you could turn on within 30 days.
Right.
In some cases, it could take a little longer, but roughly think about a month or two.
So we had a webcast earlier this week for clients to discuss the Middle East conflict situation, and I was struck by how many questions there were on the Straits of Hormuz. What's their significance?
It's a very important artery for oil flows. Around 18% of world oil transits through Hormuz. And it's all outbound to export markets, right? So about 80% of that oil goes to China. It's very narrow. Yeah.
From our listeners' perspective, where is the Strait of Hormuz?
It's basically the strait that closes the Persian Gulf.
Right.
Right.
And it is actually remarkably narrow, isn't it?
It is very narrow at its narrowest point.
And it has a lot of traffic going through it.
It does, yes. And in fact, there was a tanker collision earlier this week, which was just completely unrelated to the current conflict, but just due to navigational issues. Just goes to show it is a choke point. It is very narrow. So 18% of world oil transits through there, and it's oil being exported out of Saudi, so multiple countries, Saudi, Iraq, Kuwait, the UAE, and of course, Iran itself. Now, it's worth bearing in mind a closure has never happened before in the 80s or in the first Gulf War. But let's say if trade was disrupted for whatever reason, there would not be enough spare capacity to redirect that trade elsewhere. The most spare capacity you have is through the Saudi east-west pipeline that crosses the country and goes to the Red Sea, right, which would provide another export route. It's not fully utilized today, but it would only be able to deal with a portion of just the Saudi export volumes, but not the rest of it. And then for gas markets, Hormuz is even larger. It's a quarter of global LNG trade.
Wow.
And we've already seen gas prices go up on the back of the current events.
So, Murat, just listening to Kim, there's a lot of uncertainty. But is it fair to say that there was already a quite significant uncertainty premium factored into markets based on everything else that had been going on in the markets? But does that account for the fairly muted reaction in the markets up till now?
Thanks, Piers. Indeed, in the first few days of after the escalation of geopolitical events, we can say market reaction was fairly muted. Although I see that a bit of a risk-on behavior is picking up over the last few days as investors are trying to understand how this situation will unfold, whether it will intensify, escalate, etc. We've seen, to Kim's point, further upward pressure on oil prices, maybe geopolitical risk premium. We've seen US dollar actually reversing some of its losses. Some people call it a short squeeze. Has been a bit of a demand for US treasuries where yields have fallen, prices have gone up a bit. But overall, I think you're right. I think you can say that there are already a lot of other things going on in the background for the investment environment. And obviously the most important one is the trade tension, tariffs. And then we had bond market volatility over the past few months. And tariffs may come back to the agenda again because the reciprocal tariffs have been on hold since early April for 3 months, the so-called truce period. And that is ending in early July, although, further delays are always possible. We don't know. But the attention might turn back to tariffs. There are so many things going on. You're absolutely right. Already a lot of risk premium, but now markets are trying to make sense, what is going to happen with the geopolitical environment and whether actually that will kind of override or become more important, and the tariff issues will be put at the back burner again throughout the summer months. So lots going on. In the beginning, a bit of a muted reaction, but over the past few days, we are sensing some risk of behavior as there are some worries about what's happening in the Middle East.
Just listening to your response, is time a key variable, and in particular in the context of inflation? After all, there was a general sort of sense, I guess, that the spectre of inflation had been beaten into submission. How long does this situation have to prevail before markets start to worry that inflation could become a negative factor again?
Yeah, it all hinges on oil prices. And, obviously, as Kim has mentioned, we haven't changed our baseline scenario, but clearly there are now risks. And, global economy is impacted by oil prices pretty rapidly, especially emerging markets. They have a much higher share of energy in their consumption basket compared to the developed world. And to your point, inflation, well, I wouldn't say completely beaten, but definitely has been moving in the right direction. Central banks found the room to cut rates. Even today we had Swiss National Bank, Norges, Philippines cutting interest rates. It's been ECB, it's been New Zealand, India, South Africa, Korea. Left, right, and center, there have been a lot of monetary easing going on. We are in a global easing cycle. Yes, the Fed is on hold, but we expect them to resume rate cuts later in the year. So it's a global easing cycle on the back of moderating inflation pressures. It has provided the room for interest rates to come down, the policy rates, but now we're faced with an upside risk here. If the oil price increase is persisting, then obviously it's going to impact headline inflation, maybe less so core inflation. But I think the central banks will take note of it, and they may have to reevaluate and reassess.
Is there a danger, sort of wearing your strategist hat, that the markets are so focused on what's going on in the Middle East that they don't pay attention to other developments? I ask this is a loaded question because I ask it in the context of signs that the economic data out of the US is beginning to deteriorate.
Certainly. Piers, we live in such a complicated investment environment, and the themes impacting markets are changing, weekly, if not on a daily basis. We've been through a lot over the last 6 months since the beginning of the year. And many of them, they still are lurking in the background. And as I mentioned, the tariff trade issue might come back to the fore again. I mean, yesterday we had the FOMC meeting and the Fed, they still want to wait and see, how the tariff situation is going to impact the economy, both employment and inflation. And they've been pointing to upside risk to unemployment, meaning downside risk to growth and upside risk to inflation. You're absolutely right. I mean, that is another major uncertainty in the background. Now, further compound of what's happening in the Middle East. I mean, you're right that we have to deal with a lot of issues at the same time, and that makes the investment environment very uncertain and very, very complex.
Now, I'm not going to say how many years you've been covering emerging markets, but long enough to have seen many, many cycles. Traditionally, emerging markets in times of crisis have tended to accentuate the reaction exhibited by developed markets. Is it fair to say that today some of them are actually much more resilient?
You can say that. And as a matter of fact, up until these geopolitical events, there was almost like a consensus in the market that this is a pretty good environment for emerging markets. And right after the Liberation Day, we've actually come up with a call of being quite positive and constructive on emerging market local currency denominated assets, local debt and equities. Why? Well, first of all, US dollar is no more a headwind. If anything, it's a tailwind, or at least it has been so far. Then you have emerging markets offering you pretty significant real and nominal risk premium, interest rate buffer. And now emerging market central banks, they have the room to cut them, which helps local debt, which helps local equities. It has been an asset class with very little investment over the past few years. Since COVID, it was predominantly investment in US financial markets, and emerging markets have actually seen a lot of outflows. So you can argue even technical positioning is actually pretty attractive. And the valuations, emerging market assets, be it debt or equities, they present pretty attractive, compelling valuations. So because of all these reasons, we thought emerging markets are in a right place. And a lot of the fiscal issues you see elsewhere around the world, the bond market volatility, be it in the US or in Japan earlier or in the UK, a lot of emerging markets have been through that, and the fiscal policy was moving in the right direction. Even in countries like Brazil, where we had a risk premium late last year, recently all the news flow on the fiscal side was actually quite encouraging, meaning that the fiscal issues or the risk premium has been gravitating more towards the developed world. So everything together appears, you're right. I mean, there is a case you can make that emerging markets are more resilient, generally running good macroeconomic policies, generally offering pretty compelling risk premium buffer, given the uncertainty in the investment backdrop. And we've been quite constructive. We still are, but obviously we need to watch what's happening with the geopolitical risk very closely.
I don't want to get too technical, but your team did an interesting analysis of the treasury market going back to 1963. Was the takeaway that oil prices matter, but so does context?
100%. So generally speaking, US treasuries trade in a relatively tight range on the back of geopolitical developments, unless it's a major oil price shock, then the rates are trending more upwards. But as you say, the context matters. I mean, the last time we saw this was actually in early 2022, the Russia-Ukraine war, where actually treasuries the yields tended to go higher in the aftermath, but the context was high inflation or spiking inflation after COVID and the commencements of the Federal Reserve's rate hiking monetary tightening cycle. So the context matters. But if it's not a major oil price shock, we tend to treat them more probably in ranges. That kind of is valid for equities as well. Alistair Pinder, our global and EM equity strategist, he did a similar analysis, and he was mentioning the webcast that you referred to, that generally equity markets tend to fade the geopolitical risk premium. Again, long history, we've seen S&P and other US markets recovering some of the immediate losses in the following 3 months post major geopolitical events. But if it's like a major oil price shock, then the behavior is different. Then perhaps you can argue that equities could be a bit weaker and rates could be trending higher if the geopolitical event is accompanied by a major oil price shock that is persisting.
Okay, we're nearly out of time here, but Kim, can I come back to you? Obviously, you'll be watching the oil price. We all will. But what other data are you keeping your eye on?
It's hard to get away from the oil price. And so with that in mind, I would watch OPEC strategy and what they do.
How often do you get data on their production?
A few times a month. We get it from different data sources. We also watch what they're going to say and announce in terms of the future production increases. So maybe the context is that OPEC strategy was one of two major developments before last Friday that was impacting oil prices, together with, of course, U.S. tariffs. So they've started to unwind their production cuts, which had been in place since late 2022. They surprised the market earlier this year when they announced accelerated output hikes, and that put downward pressure on oil prices. But now with prices back above $75 and risk of disruption, OPEC will likely feel even more comfortable pushing on with those accelerated supply hikes, right? And that could help to cool the market and to lower oil prices. So we're watching that, and their next meeting is in 2 weeks, so stay tuned. Well, I'm also watching China from a couple of angles.
Oh, yes, of course.
So they can be quite nimble in terms of buying oil for their strategic reserves. So until very recently, oil was still in the 60s, so they might still be purchasing oil to fill up their strategic reserves. But more kind of fundamentally, China is approaching peak oil demand. And on Tuesday, the IEA said that China's oil demand will peak in 2 years' time, in 2027. And if they're right about that, it could be deflationary for oil prices.
Very interesting. And Murat, do we expect much from policymakers and central banks over the summer? Was it Christine Lagarde who basically implied that it was time to go to the beach?
Well, Piers, that is our expectation as well. Relatively quiet summer. Well, hopefully not famous last words. Yeah, I think we believe European Central Bank is done. The Fed will probably pick up or resume rate cuts in September. We got September cut and December cut. Bank of England, we have the next cut in August. But up until then, generally quiet. Also across emerging market central banking universe, rates are biased to go lower, if not, maybe sideways. I mean, we had one major central bank who has been in a hiking cycle, bucking the trend. That's Brazil. With the rate hike yesterday, we think they'll be on hold for a while and potential next move is down. So yes, overall, we're hoping for a quiet summer. We expect central banks being broadly on hold across the developed world universe. Well, at least the major ones, Bank of England cutting the next one in August, and emerging market central bank being biased lower or sideways. But again, there's so many layers of complexity and uncertainty. We need to be very vigilant. But currently, that's the view.
I can say with some certainty that we'll be having you back on the podcast before too long. But for now, thank you very much for joining us, Kim and Murat.
Thank you.
Thank you, Piers.
That was Kim Fustier and Murat Ulgen on market reactions to the Iran and Israel conflict. If you're an HSBC client and want to know more, then take a look at our report published earlier this week, where our global economists and strategists tackle key questions about the escalation. You can also keep up to date with our latest research by downloading our app from Apple's App Store or Google Play. If you have any questions or comments, then please email us at askresearch@hsbc.com. And don't forget to like and subscribe to the Macro Brief wherever you get your podcast. So that's a wrap. Thanks very much for listening, and we'll be back again next week.
Thank you for joining us at HSBC Global Viewpoint. We hope you enjoyed the discussion. Make sure you're subscribed to stay up to date with new episodes.